Hello dear students, in this video I will be covering the topic of deductions from gross total income. So before starting with this chapter, let us just understand the basic rules which we have to keep in mind while calculating the deductions. Number 1, the deductions are given in chapter 6A of the Income Tax Act, and there are various deductions which are covered from section 80C to 80U which are allowed from the gross total income of the assessee. Now, the aggregate income of deductions under section 80C to 80U cannot exceed the gross total income. What does it mean? It means if your gross total income is, for example, if your gross total income is nil, so in that case you cannot claim the deduction. Or let's suppose your gross total income is rupees 5 lakh and the amount of deduction is rupees 6 lakh. So, this 6 lakh cannot exceed the income which is rupees 5 lakh, you have to restrict it. Next, when we talk about deductions, the first section that comes is section 80C. Now, section 80C deals with deduction in respect of life insurance premium, contribution to provident fund, etc. So, first of all, let us just understand what is basically this section 80C, and after that we will be covering the various modes of investment where you can do the investment and you can claim the deduction under section 80C. So, under section 80C, the first question is who can claim the deduction. So, as we can see on the screen, any individual or HUF can claim the deduction under section 80C. Next thing, the qualifying investment to claim deduction. So, if you are an individual or an HUF and you want to claim the deduction under section 80C, you can make savings in specified mode of investments. I will be covering these specified mode of investments in the next few slides. Next thing is how much amount is deductible under section 80C. So, as per the limit mentioned, the maximum amount that can be claimed under section 80C is rupees 1,50,000. And the next point which we have to keep in mind is what is the basis of deduction. So, the basis of deduction here is payment basis. For example, if you have made the payment or if you have contributed rupees 1,10,000 to PPF, right? In that case, since the payment has been made, you are eligible to claim the deduction under section 80C, right? So, here the deduction can be claimed only on payment basis, on due basis you cannot claim the deduction. So, this is the basic overview of section 80C where an individual can claim the deduction by making investment in specified modes, and the maximum amount deductible is rupees 1,50,000. Deduction is allowed on payment basis. Next thing is, these are certain mode of investments. Number 1 is life insurance premium. So, the first thing is the life insurance premium. Here the individual or HUF can take the insurance policy. Individual can claim the deduction for any insurance policy taken for himself, for his spouse or for his children. Now, children may be dependent or independent, major or minor, married or unmarried. The point which we have to keep in mind is when is the policy issued. So, if the policy is issued before 1st April 2012, the maximum premium amount that can be claimed as deduction is 20% of sum assured. For example, the amount of policy is rupees 4 lakh, right. So, in that case 20% of 4 lakh would be 80,000. So, the maximum claim that can be claimed under section 80C is rupees 80,000. So, the next deadline is policy issued on or after 1st April 2012. So, if the policy has been issued on or after 1st April 2012, the limit is 10% of sum assured. And the last thing is, if the policy is issued on or after 1st April 2013 for the insurance on the life of a person referred to in section 80U to 80DD, in that case the limit is 15% of sum assured. Now, this section 80U or 80DD will be covered in our subsequent slides. Next is, these are different modes of investment where you can do the savings or investment and you can claim the deduction under section 80C. This is the public provident fund known as PPF, where you can deposit a minimum amount of rupees 500 in a particular financial year and the maximum deposit can be of rupees 1,50,000. Here the lock-in period is of 15 years. An individual can also make investment in equity linked savings schemes. You can also deposit money in 5-year term deposit and claim the deduction under section 80C. Next, if you have paid any installment or part payment towards the cost of purchase or construction of any residential house property, again for the amount of payment made, you can claim the deduction under section 80C. You can also subscribe to the national savings certificates issued by the government, and deposit can also be made in Sukanya Samriddhi Yojana. Basically, this is the scheme launched by the government to promote the girl child, education of girl child. Next is the deposit in senior citizen savings scheme. You can also make investment in this particular scheme to claim the deduction under section 80C. Lastly, any sum paid towards the tuition fees of a child can also be claimed as deduction under section 80C. So, this is the list where you can make certain investment and you can claim the deduction under section 80C. Next is the deduction in respect of pension fund covered under section 80CCC. Again, here we have to see who can claim the deduction. So, the deduction under this section can be claimed by an individual. Next, the amount that can be claimed as deduction here is the amount paid or deposited in the previous year by such individual out of his income chargeable to tax for any annuity plan of LIC of India or any other insurer for receiving the pension. The maximum amount deductible here is again the amount paid or deposited or rupees 1,50,000, whichever is lower. For example, if you have paid rupees 1,40,000, so you can claim 1,40,000 under the section 80CCC. However, if you have deposited rupees 1,60,000, so you will be restricted to 1,50,000 because that is the maximum limit. Next is what will be the treatment of pension which you will be receiving out of this fund. So, the pension received by the assessee or his nominee will be taxable in the hands of recipients in the year of receipt. So, whenever you are going to receive the pension, that will be taxable in your hands or in the hands of your nominee, whosoever will be receiving the pension. The next point which we have to keep in mind here is the double deduction is not allowed. What does it mean? It means if you have claimed deduction of the same amount under any section, for example under section 80C, then you cannot claim this deduction of same amount under section 80CCC. And lastly, 3 sections together make a ceiling of rupees 1,50,000. So, deduction under section 80C, which we have already covered in our previous slide, deduction under section 80CCC, that is deduction in respect of pension fund, and 80CCD1, which we will be covering in our next slide. These 3 sections together make a ceiling of rupees 1,50,000. Next is the section of contribution to NPS, section 80CCD. Now, this section is very important because this section has various subsections and we have to understand each and every subsection. First of all, we will be covering the section 80CCD1. What is this section 80CCD1? It says that if a deduction or a contribution has been made by the employer or the employee to NPS, then what is the treatment? So, contribution to NPS can be studied by dividing this section 80CCD into 2 parts, 80CCD1 and 80CCD2. So, first I will be discussing 80CCD1, then I will be discussing this section 80CCD2, and later on I will be covering the part 80CCD1P. Let us just understand 80CCD1. See, contribution to NPS can be made by 2 parties, the employer as well as the employee. So, if the contribution has been made by employee, the maximum amount of deduction that can be claimed by him is 10% of salary or employee's contribution, whichever is less. Similarly, if the person or the assessee is a self-employed person, right? So, in that case, he can also join the scheme of NPS and the maximum amount of deduction that he can claim is 20% of his gross total income or his contribution, whichever is less. So, there is a ceiling. If the contribution has been made by employer, you have to remember the rate, that is 10% of salary, and if the person is self-employed, the rate is 20% of his gross total income. So, this is section 80CCD1 where the contribution is made by the employee himself. Next comes the section 80 CCD2 where the contribution is made by the employer, right. So, if the employer has made the contribution to NPS, what will be the treatment? First of all, this contribution will be treated as part of the salary income of the employee, and later on he can claim the deduction under section 80 CCD2. The maximum amount that can be claimed by the assessee as deduction is 10% of salary or employer's contribution, whichever is less. Now, in the case of government employee here means the central government employee, right. The central government employee can claim the deduction up to 14% of the salary. Fine. So, salary here means basic salary plus DA forming part of retirement benefits plus the commission. Which commission? The commission if it is calculated on fixed percentage of the turnover achieved by the employee. So far I have covered two sections, that is 80 CCD1 and 80 CCD2. When we talk about 80 CCD1, it is basically the contribution by an employee. When we talk about 80 CCD2, it is contribution by the employer. Fine. So, let us now understand the next section, that is 80 CCD1B. So, 80 CCD1B is for the individual's contribution. So, if you want to make an additional contribution to NPS, you can claim the deduction up to rupees 50,000 in this section, and this deduction has been claimed and allowed for the amount contributed by an individual. The same amount cannot be claimed as deduction under section 80 CCD1B. Next is the section 80 CCE. This makes a ceiling on the section 80C, CCC and 80 CCD. So, what is this ceiling? The aggregate amount of deduction under section 80C, CCC and 80 CCD1 cannot exceed rupees 1,50,000. What does it mean? For example, if you have made certain investment in PPF or in equity linked savings schemes and the amount of investment is rupees 1,20,000, you can claim the deduction under section 80C. Right. If you have contributed to pension fund, let us say rupees 20,000, you can claim the deduction under section 80 CCC. Fine. So, 120 plus 20 makes 1,40,000. And next, if you have contributed to your NPS, right, you can claim the deduction under 80 CCD1. So, this 120 plus 20 plus whatever contribution you have made towards this NPS scheme which you want to claim deduction under section 80 CCD1, this limit cannot exceed rupees 1,50,000. However, the deduction to be claimed under section 80 CCD1B and 80 CCD2 are not covered in this limit. Next, let us come to the deduction in respect of medical insurance premium, which is covered under section 80D. Here also the first point which we have to remember is who can claim the deduction of section 80D. So, this deduction can be claimed by an individual or HUF, right. Next, to claim the deduction of this medical insurance premium, you have to see the mode of payment, in which form you are making the payment of this premium, right. So, payment should be made by any mode other than cash, but if you are making the payment for any preventive health checkup, then you can make the payment in cash, otherwise the payment has to be any mode other than cash. Next thing that we have to remember is payment should be made out of income chargeable to tax by any mode other than cash. For example, if you have to claim the deduction of section 80D, so you have to make the payment out of your income which is chargeable to tax only. Next, preventive health checkup, the limit here is rupees 5,000. So, the aggregate payment on account of preventive health checkup of self, spouse, dependent children, father and mother cannot exceed rupees 5,000, because 5,000 is the maximum limit that has been specified by this section. So, in 80D, what we have to consider, we are going to divide this deduction that can be claimed by an individual for two categories, family and parents. When we talk about family here means the individual himself, spouse of the individual and dependent children of the individual. Please keep this point in mind. Here we are considering only the dependent children of the individual. So, if the children are independent, they are not going to be considered in this definition of family. Next is When we talk about parents, parents here are father and mother, and father-in-law and mother-in-law are not included. Now parents, they may be dependent or independent, it does not make any difference. What you have to remember is, in the case of children, the children have to be dependent. In the case of parents, whether they are dependent or independent is irrelevant. Next, the point is, who is a senior citizen? Why I am discussing these points? Because later on we will be doing the question, and these points are going to help us in solving the problems. So, senior citizen, who is a senior citizen here? Any resident individual who is at least 60 years of age at any time during the previous year is considered as a senior citizen. Next is the maximum deductible amount. So, I have divided this slide into two parts, family and parents. In the previous slide only we have covered the definition of family, which says that family includes individual, spouse and dependent children. And when we talk about parents, they include father and mother. So, for family we are going to consider individual, spouse, children, dependent children, and parents, father and mother. Now next, for medical insurance premium, both family and parents are eligible to claim the deduction under section 80D. If you have made the contribution to CGHS or any notified scheme, in that case for family it is eligible, it is allowed, for parents not allowed. Next, preventive health checkup payment, again for both the categories, that is family and parents, the deduction is allowed. Next, there is a limit, maximum deduction for family as well as for parents given here is together is 25,000 respectively. For example, if you have made contribution towards medical insurance premium of rupees 22,000 and for preventive health checkup let us say 6,000, right. So, 22,000 plus 6,000, they together make a amount of 28,000, but here we are going to restrict it to 25,000 only. Next, in the case of a senior citizen, there is an additional deduction of rupees 25,000 allowed in both the categories, that is for family as well as for parents. Fine. So, in the next slide, I will be discussing these deductible amount in detail. Let us say, let us divide it into two categories, that is family and parents, and let us see the maximum ceiling. So, if the individual is of the age of below 60 years, then the maximum deduction that he can claim is 25,000, right. If parents are also below the age of 60 years, again for parents the limit is 25,000. So, if he has made any contribution towards medical insurance premium, the maximum amount that he can claim is 50,000, 25,000 for family, 25,000 for parents, right. Next, in the case of individual who is below 60 years, again the limit will be 25,000. But if the parents are above 60 years, so in that case there is an additional deduction of 25,000, that makes 50,000. So, for family it will be 25,000, for senior citizen parents 50,000. So, maximum deduction that he can claim is 75,000 rupees. Fine. Lastly, if individual is more than 60 years of age, parents again more than 60 years of age, for senior citizen in the previous slide only I have covered that for senior citizen there is an additional deduction of 25,000. So, which makes this ceiling of 25,000 to 50,000, right. So, in the case of senior citizen individual, the limit is 50,000, senior citizen parents, the limit is 50,000, which together makes a maximum deduction of rupees 1 lakh. So, what we have to keep in mind is, for individual 20,000 who is below the age of 60 years, for parents again 25,000 below the age of 60 years, and together 50,000. If the individual is below 60, parents are above 60, then 25 plus 50, it is 75,000. Individual is below 60, individual is above 60, parents are again above 60, right. So, 50 plus 50, the limit is 1 lakh rupees. Next is deduction in respect of maintenance including medical treatment of a dependent who is a person with disability, section 80DD. Here, with the help of this 80DD, we can remember this section, dependent, disabled. These are the keywords. So, 80DD means dependent, disabled. Again, who can claim the deduction under this section? The deduction can be claimed only by a resident individual. That means you have to be a resident, right? What is the qualifying investment to claim this deduction? Any amount incurred for the medical treatment, including nursing, training and rehabilitation of a dependent being a person with disability, or any amount paid or deposited under any approved scheme of LIC or any other insurer or UTI for the maintenance of a dependent being a person with disability. So, if you have incurred any expenditure for the medical treatment of a dependent who is disabled, in that case you can claim the deduction of 80DD. The maximum amount deductible under this section is there is a fixed amount. If the disability is 40% or more, the maximum amount deductible or the fixed amount of deduction is rupees 75,000. But if the disability is severe, let us say it is more than 80%, then the fixed amount of deduction is rupees 1,25,000. Here the deduction is allowed irrespective of actual expenditure. So, let us say if you have incurred rupees 50,000 on the medical treatment of a dependent disabled, so in that case, irrespective of your actual expenditure of rupees 50,000, we are going to allow you the deduction of rupees 75,000, right? And if the disability is severe, if it is more than 80%, then the fixed amount is rupees 1,25,000. So, for dependent disabled, there is a ceiling of 75,000 and 1,25,000 respectively. Now, let us just understand the meaning of dependent. Who is treated as dependent here? So, the spouse, children, brother or sister of the individual who is wholly or mainly dependent on such individual are covered under this category. Now, the last point which you have to keep in mind is to claim the deduction under section 80DD, it is mandatory for the assessee to furnish a copy of the certificate issued by the medical authority. So, this is our 80DD for dependent disabled. Next is deduction in respect of medical treatment 80DD. So, in the previous slide only we have covered 80DD. Here we are going to discuss 80DD. What is the difference between 80DD and 80DD? Here the disease has to be specified by the board. So, DD dependent disabled and the disease is specified by the board. So, the amount is any amount incurred for the medical treatment of a specified disease or ailment as prescribed by the board, or any amount of expenditure it should be incurred on the assessee himself or on the dependent. Here the amount deductible is the actual expenditure or rupees 40,000, whichever is lower. So, in 80DD the deduction does not depend on the amount of actual expenditure, but here it depends on the amount of actual expenditure. So, if you have spent 35,000, we will give you the deduction of 35,000, but if you have spent 45,000, we will give you the deduction of rupees 40,000 only. In the case of senior citizen, this limit of rupees 40,000 has been raised to rupees 1 lakh. So, again here deduction shall be reduced by the amount received from any insurer, reimbursement from employer. So, if you have received any amount as reimbursement from the insurance company or from your employer, that amount is going to be deducted from the amount which you want to claim under 80DD. Here also the term dependent includes the spouse, children, parents, brother or sister of the individual who is wholly or mainly dependent on such individual, and the assessee is required to obtain a prescription from a specialist doctor for the purpose of availing this deduction. So, this covers our deduction 80DD. I hope this section 80DD is clear. Thank you. In the next in the next part we are going to solve the question based on these deductions. Thank you.